Hi, my fellow student. It's my pleasure to give this brief introduction about the financial management and the investment and the financial market. This is a very basic introduction course for you to understand what we can learn from finance. Okay? So basically, we call this is a finance. Sometimes even I use the topic of financial management. We cover several subjects. Okay, so let's start with what's the finance. Okay, basically one of the major purpose we learn finance is trying to maximize shareholders' value. Corporate, they do the investment to buy the asset to earn the money is because they want to maximize the firm value, so the shareholders' value will maximize. Okay, and also as an individual, you want to buy stock, you want to buy the bond to make money. Okay, instead of just putting the money in the bank to receive the regular deposit, usually that interest rate is very low. You want to earn on the financial market more return. So in finance, you have to learn not only the knowledge of the financial management, you have to integrate the economic, statistical, accounting, even the law and the computer science together to learn what finance looks like. Okay? So in this course, I will cover three things. Basically, corporate finance and the investment. I only use the last few minutes to talk about the financial market, okay? Because this is a really brief introduction, okay? This is a typical picture we usually use for the student to understand how the financial market works. On the one side, there's a corporation. On the other side, there's an investor, or usually we even can call the household. So, if I'm someone, I want to do the investment in the market, okay? I will go to the financial market, okay? I'm the corporation, I will borrow the money, or I will issue the stock to get money to finance my business. And the investor will put their money into the financial institution or mutual fund or any of the stocks to say, okay, go to the financial market, we invest on the corporate, so they make money and they give me the return. Either we will receive the interest payment, dividend payment, or we will get the additional value on the stock or bond. So when you invest on here to get a stock, to get the bond, you will get those stock and bond as a financial instrument, so they individual provide a fund to the corporate. There's one agent in this market is called government. Government is one of the type institution, they supervise this market. They not only take the money from the business as a tax, using tax, they also try to regulate the market and make sure the market will work for the both sides of the market, not only for the investor, but also for the corporation. Okay? This is the usually we learn in the basic financial management class. Okay? You can learn how much you can earn on the interest rate, compound interest rate. Okay? There's a simple interest rate, there's a compound interest rate. The difference between the simple interest rate and compound interest rate is simple interest rate, your principal is always the same for every period in the future. But a compound interest rate, every period when you earn the interest, then the interest will be part of the principal for the next period. And it will rolling over period to period. So you will get a much higher return compared with the simple interest rate. Suppose you want to know that how much you're going to get in the future and how it works at the present value. You're going to learn how to do the discount. Okay, you will discount the future value to the present value so you can compare the different project, different cash flow. So this is another important thing you have to learn. So the first two things, actually for most of the students in the high school, you probably learn these two formulas: compounding interest rate, simple interest rate, and the discounting to the present value. Okay? So on average, you can learn, so you summation all the future and divide it by the number of the period. That's called the average. And you also can get a standard deviation. We're going to use this formula later in the investment, because we need to know the risk of return. We wait later to explain, because even we made a small mistake on this formula. I'm going to show you the right one later. Okay, let's start with the corporate finance first. That's usually the first class I teach in the school. Okay, the first thing you learn, called the corporate finance. You learn this is because you are able to interpret the financial statement. Okay, you're able to the financial statement. Okay, so the other things I have to mention is in the financial statement, in the corporate finance, there's 4 different subjects you have to learn. The first one is called the capital budgeting. You learn how to evaluate each of the projects you want to invest, whether they are able to create the value for your firm. That's called the capital budgeting. Many of the people see, oh, this is the subject that the finance people in the corporation need to know. Actually, I say no. This is something everybody in the corporation need to know, because every division in the corporation, they need to deal with the different project, and they need to know how to evaluate the project availability or whether they can create the value. So one of the things that we're going to learn is the capital budgeting. We're going to teach you the method in here. Another thing is, you want to do the capital budgeting for the investment on the company, then you also have to do the capital structure, because that's where the money comes from. You want to do the investment in here, you got to know where the money coming from. So you want to know money either coming from the bond or from the bank you borrow, or you issue stock to collect the money from your stockholder. So company have to make the decision how much money they have to collect from the bondholder, from the liability side, how much money they're going to collect from the equity side. So you have the decision to say where the money coming from. You have this money, then you can invest on the capital budgeting. Okay, so on the different project. So those two things are very critical for your balance sheet and the income statement. But there's the third thing. It's called the working capital management. Many of the company, they have to deal with their finance every day. They deal with their cash management, inventory management, account receivable account, account payable account. So you got to know how to deal with your money, your cash flow every day. That's called working capital management. Okay? So that's the third subject. Usually from every textbook in the corporate finance, this is the typical 3 subjects you will cover. Capital budgeting, capital structure decision, and the working capital management. In here, I put the 4th one in here, is called the dividend policy, is saying, if you do everything correct in these 3 things, you make money. Once you make money, you have to make the decision whether you want to distribute your earning to your shareholder. Okay, of course, you borrow the money, you have to pay interest, you have to return the principal, there's no doubt. But if after you pay the interest and the principal back to your liability side, you have some money left, you have to make the decision whether you want to pay the dividend to your shareholder, to your equity holder. Then you have to say, okay, some of the companies say, I'm going to pay the dividend. Some of the companies say, no, I will not pay the dividend. But there's a lot of reason that the company will pay the dividend. Because they say, if we pay the dividend, that gives signal to the market to say, hey, you invest my company, we make money, you want to get a return. So that gives you a signal saying, this company doing the job correct, doing the job properly. But some of the companies say, no, I don't want to pay dividend. I want to keep the money in order to promote the company continue to grow. If this is the case, the company will not pay the dividend. I give you one of the example is in Taiwan from 1990 year 2000. Most of the company in Taiwan, I would say 95% of the company in Taiwan, they don't pay cash dividend. They only pay stock dividend. What's the difference on that? That means the company doesn't have a cash outflow to anybody if they pay stock dividend. If they pay the cash dividend, they have to use their own money to give to their shareholders. Okay? So that's, they will decide whether they want to pay the dividend. And when you pay the dividend, people will think you must be doing good job. That's why you have the value that you're going to invest. But in 1990 to 1999 or 2000, most of the company in Taiwan don't pay cash dividend, 95%. But after year 2000, the case totally different. The situation totally changed. Most of the company, I would say 99% till today, 2025, 99% of the company, they will pay cash dividend. Okay, so that's the difference. There's a reason. Okay, you got to learn that in this course. Okay, so let's start with the investment decision for fixed assets and generating a series of the future profit. The reason is we want to invest on the capital budgeting, so we buy asset. We buy equipment, we build the plant, we buy the land, so they can run the business, so they can sell the product and service to their customer. Once they do that, they do the long-term investment, they make the profit in the future. And usually those kind of investment will last for a longer period of the time. So this kind of investment is what we call the capital budgeting. I give you one example, is like our high-speed rail, HSR. That's our capital budgeting decision. They invest several hundred billion NT dollars to build the HSR, and it will last 50 years. Okay, so we have this construction. Usually this kind of project is called a project financing. Project financing is a type of the capital budgeting, which is a very large, very big investment for the future profit. So you're going to calculate NPV. I say, I will calculate how much money I'm going to invest, how much money I'm going to earn in the future period. For all the profit I learn in the future period will discount to the present value and compare with my initial investment, whether I can create a positive value, which is a net present value. If the net present value increase, which is greater than zero, that means it create the value of the first. So that means that's a good project. So whether you're going to evaluate that's a good project or not is based upon that the NPV is positive or not. I give you one example. You can see Mr. Wu plans to invest 10 million to open a new restaurant. Okay? He expects the annual profit is 1.9 million for 5 years. with an average interest rate of 2%. So should he take the project? Should she proceed to do the project? So you can see 190, 190, 190, 190, 190. Most of the students say, oh, 5 years to get it. So we calculate together, we find out this number compared with the $1 million, $10 million, am I using the right number? Okay? Am I getting the right number? Actually, this is not I shouldn't have all the number in here, but instead of here, we discount the present value. The 5th year, discount 5 times. 4th year becomes 4 times. 3 year becomes 3 times. 2 year becomes discount 2 times. 1st year discount 1 time. And compare with this is all the present value add together, compare with your initial investment, you got a negative. So this tells you this project is NPV less than 0, you should not take the project. Okay? So that's a very easy way to evaluate. Okay, so that's the first thing you learn for the corporate finance, capital budgeting. Well, the things I didn't go through is taking much longer time to teach you how to get those numbers. You got a 190, where did the 190 coming from? That's coming from your balance sheet and the income statement. Okay? So that's called a cash flow estimation. That's an accounting job. It's a little bit difficult. I'm not going to cover it right now, since this is just a brief introductory course. Okay, I will highly suggest you take this course. You got to learn that in detail. The second thing I want to talk about is the capital structure. Remember, you just making the decision, say, oh, there's a good project. I'm going to invest because I'm able to invest on that project to create a positive NPV value. So that's good. But the problem is, where's the money coming from? Remember previous case, we need to invest $10 million. Where did that $10 million coming from? Some people say, oh, must be coming from your own pocket. No, that's not the case. Most of the time, when the business do the investment, they don't just use their own money. They use other people's money. Okay? If this is the case, you're going to borrow the money, you're going to issue the new equity, you have to make the decision. How much money you're going to borrow from the bank? How much money you're going to issue the corporate bond? How much money you're going to issue the stock to ask the equity holder to buy your stock? That's called the capital structure decision. Okay? Once you have the capital structure decision, you have to decide the amount of money you borrow. Okay? The amount of money you borrow. You say, okay, I borrow the money, I issue corporate bond. But the $10 million, I issue 5 million corporate bond. The other 5 million, I'm going to issue the stock as the equity holder to invest on my company. So equity holders say, okay, I want your company give me 15% return. And the corporation bought the bond market may be saying, oh, I wish you can give me 5% return on the interest payment. So if this is the case, you can calculate. You probably will ask me, Professor, why equity holder has a higher request on the rate of return compared with the bondholder? Because bondholder has priority to get their money back when the company is going to bankrupt. Equity holder is the residual claim. They cannot claim anything unless all the liability has been paid. Because of that reason, shareholder has higher risk compared with the bondholder. So shareholder were willing to have a higher rate of return because they bear high risk, and the bondholder willing to have a lower rate of return because they have first priority to get their money back. is the weight. This is the 50% of the weight that I used, borrow 50% I used to issue the equity. But there's an additional thing, is 1 minus T. Why there's a 1 minus T? 1 minus T is because every interest payment you pay, it provides as an expense in your income statement, so they will give you tax shield advantage. Tax shield advantage. So if you have a tax shield advantage, that will lower your cost of the debt because you have an advantage. So actually, when you want to consider the cost of debt, you also have to consider the tax shield advantage. But the shareholder doesn't provide such advantage. Then, once you have the bondholder cost of the debt and you have the shareholder cost of the equity, you weighted average together, you can get weighted average cost of the capital of your company. Okay? So that's very important for you to learn that for this company, what type of the cost they have to bear with. So for example, this company have a plane. They want to build an automobile plane in Taiwan. It financed including 55% equity and 45% bond. With the expected rate of return for equity is 9% and the interest payment is 5%. And the tax rate in Taiwan, corporate tax rate is 22%. You use the formula, we can calculate the weighted average cost of capital. That's the weight for the bond, 45%. That's the cost of the debt, cost of the bond, 5%. And this is 1 minus the tax rate. That will count your tax shield advantage. Plus, you can have a 55% of the shareholders' investment, and then they request 9%. You put together, you know your weighted average cost of capital in this company is 6.7%. Okay, so you got to know how to calculate this cost of capital. You got to know how you're going to finance your business. Okay? The next one I want to talk about is working capital management. Working capital management. Okay? You every day you have to pay out some money to your supplier. You have to collect the money from your customer. Okay? You have to prepare the inventory. Okay? So there's a lot of things you have to handle every day. Okay, like this, we want to make sure the liquidity of our cash in the business is enough to handle our daily business. Okay? So we need to know how to do that. What we have to do is, for example, I want to manage how much money I have in hand every day. You face a problem. If you hold too much cash in hand, that will be a problem because you didn't put the money in the bank or in other investment opportunity. You have a holding cost. Okay. You have the holding cost. So you have this holding cost, so that holding cost is not good for you. Okay? But also on the other hand, if you hold too little cash, okay, sometimes you need to use money, you don't have enough money in hand, then you have to convert some of your current asset or long-term asset into cash. Let me give you an example. Okay? I call this B is a transaction cost. I call this C is an optimal cash balance. And T is the cash requirement for the whole year. And this is interest rate. Okay? Interest rate is the holding cost. With this formula, suppose I say, I am a corporation. I'm a person. the whole year I need to spend $2 million. $2 million. And then I also have to have the transaction cost. Every time I go to the bank, I withdraw the money, I have to pay $6 to withdraw the money. And 2 is the constant. And divided by the interest cost right now is roughly about 2%. Then you can say how much money every time I go to the cash machine I have to hold it in hand. Same thing for the corporation. You do the same thing. How much cash you should hold it in hand. This is one of the example. So I say the withdrawing cost is about 5% per transaction, withdrawing cost, okay? And the cash demand is $5 million, interest rate is 2%, and you can calculate it that you have to have this much of the money in hand most of the time, which is $15,811, okay? So you do the same thing. You even can calculate the BAT model, okay? So that's something we will talk about. You also can talk about the dividend policy, dividend policy, which is a dividend divided by I minus G. Then you can think about whether I'm going to pay this dividend. Actually, it's not that simple. It's a very complicated issue. Okay, we already talked about company can pay cash dividend, stock dividend, even do the share repurchase. You're going to learn this subject in the regular class. Okay? Another thing I want to talk about is investment. Investment, the most important thing is you got to calculate the return. Every investment, you want to know your initial cost and you want to know your selling price. Then, during your holding period, you can also get some interest payment or dividend income. We consider all these things together, you are able to calculate the return. You also, every period you have the return, you are able to calculate the variance or standard deviation of your risk. Okay? So, different asset and different return. Tangible asset like machinery, equipment, facility, the right to provide the productivity, they have their return. Financial asset like a bond, stock, warrant, they will generate the income. They will also have their risk and return. Okay? Just remember, risk is what you have to bear with for future uncertainty. So you gotta figure out how to manage your risk. Okay, it's difficult. There's a lot of ways to manage your risk. You can do risk diversification. You got to do the risk transferring. In the class, you're going to learn that. Okay? And return is the compensation. You do the investment, you bear the risk. The market say, oh, since you bear the risk, I'm willing to compensate you that you're willing to take the risk. Okay? So, one of the way we calculate the return in the proper level of the risk is called the capital assets pricing model. That's a very famous assets pricing model in the history. Okay? The inventor of this equation is called the Professor Shaw, and he won the Nobel Prize just because of this simple equation. And with the risk-free rate, market rate of return, and also the beta is a very important coefficient. You put together, you are able to evaluate the expected rate of return for each of the assets in the market. So this is one of the, for UMC, that one of the stock, if you know the historical return is 9%, okay, and beta is 2.5, and the risk-free rate is 1.7, and then you get the 19.95%. I made a mistake here. This is not a historical return for UMC. This is the market historical return, not a UMC. This is the market risk return. And beta is the change with the market. Okay? So, investment, you can do the similar things for bond, for stock, for mutual fund, even you can do asset allocation, securitization. This is the type of the bond you can invest, like a government bond, corporate bond, or financial bond. Okay? So this is the coupon rate you should learn in the bond. Okay? And then this is the typical formula we evaluate the bond. Okay, that's the price. We use the price equation, price of the bond equation. You can calculate that's a premium bond. And then this is the stock. There's a different right stock as it's a certificate that you own the company. Okay, this is the way to calculate with the golden goals model, fixed growth rate, and there's a multiple growth rate. You can calculate the bond value. And this is one of the case. You can calculate it in the golden goals model to calculate this bond price. Is the initial dividend payment with the growth rate, with the interest rate, you can calculate it. Interest rate and the growth rate. One of the significant importance is this number should be greater than the growth rate. Okay? And then ordinary investor may lack of the expertise to or time to earn investment profit, but they can take advantage of opportunity to make money through funds. You can go to the mutual fund manager help you to make money. There's a lot of type of mutual fund, growth fund, equity fund, bond fund, index fund, hedge fund. Like in last 2 years, I investment fund, I'm very lucky have a roughly 25% return. So in the fund, you have to pay the expense. Sometimes we call the fund end load, management fee, and the back end load. That's the money you have to pay to the mutual fund company. And this is the way to calculate the fund money. That's the formula. You can see the formula here. You can calculate all the cost, handling fee, and those kind of fund. Okay? And also sometimes they will do the asset securitization. Asset securitization, that's mean the company able to securitize some of the equipment, building, and allow the many investors to do the things. Okay? Like a mortgage-backed security for the housing, credit card receivable can be securitized, and real assets are securitization. Okay? So, in the financial market, okay, we want to have the doing the things in the finance, we need to have a financial market. So, it's very important we have the bond market, stock market is called a security market. You can go to the lending market to borrow the money, even you go to international market, do the foreign exchange, or you go to the derivative in order to transfer financial risk to other people, to other agents willing to bear the risk. So this is a basic introduction about financial management. You want to take this course, you're going to spend about one academic year, which is roughly about 8 to 9 months to learn the whole thing. There's a lot of subject in there. I spent the last 30 minutes to give you an introduction and hope give you a brief understanding of this course. Thank you.